Welcome, curious minds, to The Deep Dive. You know that age-old investing riddle, right? Value versus growth. It's a debate that's, well, it's launched 1,000 theses and filled countless financial conference halls. For what feels like forever, we've heard about the value premium, this powerful idea that, over the long haul, companies deemed value tend to outperform their growth counterparts. But what if that premium isn't some fixed, unchanging law of the universe? What if it's more like a chameleon, sort of constantly shifting its colors, appearing and disappearing with the underlying economic currents?
It's a truly crucial question, because assuming a constant premium, especially when it's not, that can lead to some significant blind spots and missed opportunities in investment strategy, too. We really need to look beyond the average to truly understand its dynamics.
Absolutely. Today, we're going to pull back the curtain on this very concept. We're guided by a truly fascinating and rigorous piece of research: value versus growth, time-varying expected stock returns. This paper, published in Financial Management back in 2011, comes to us from Hussein Gulen, Yuhan Zheng, and Lu Zhang. These are serious experts, and they've used a cutting-edge econometric framework. Think of it as a really sophisticated magnifying glass to peer into the hidden dynamic patterns of this so-called value premium.
Yeah, and what's truly groundbreaking here is that they're not just confirming what we thought we knew, they're introducing a new lens, a new set of tools, really.
Yeah.
Tools that allow us to see the market's underlying mechanics with far greater precision. It reveals a kind of fluidity that traditional models just couldn't capture.
Right. And our mission for this deep dive is to take you right into the heart of their findings. We're going to extract the most important insights, giving you a clearer, more nuanced understanding of how value and growth stocks actually behave in these different economic environments. We'll show you when value truly shines, why it acts that way, and what this all means for anyone trying to make sense of the market today. Prepare for some genuine aha moments, because this deep dive reveals a market far more dynamic than any static models have led us to believe. Let's unpack this. So let's set the stage for a deep dive. For decades, investors and academics have been utterly captivated by the value premium. We're talking about the observed tendency for value stocks. Think companies with low prices relative to their fundamental worth, often identified by metrics like a high book-to-market ratio, to consistently outperform growth stocks, which are typically companies with high growth potential, often with high prices relative to their book value. Sounds simple enough, right? Buy low, get more.
Exactly. And the intuition is often that value stocks are just fundamentally cheaper, offering a better margin of safety, maybe a more grounded valuation. However, the predictability of this premium, whether you could consistently anticipate when it would appear, that's always been a hot topic. Earlier studies using more traditional statistical methods, they offered suggestive evidence, as they say, but it remained controversial. Some even argued that the inherent risk in value stocks when measured against broader market risks was simply too small to explain any significant shifts in this premium over time. They saw it as more of a stable long-term thing if it existed at all, rather than something that, waxed and waned.
Right. It was almost like a statistical quirk, maybe. Something that existed on average but was hard to pin down in any given period. It felt like a constant background hum. But here's where Gulen, Jing, and Zhang take a fundamentally different approach. They move beyond those traditional linear statistical models where you assume things like a stock's expected returns or its sensitivity to economic conditions are, well, constant over time. Instead, they employ something much more sophisticated, a two-state Markov switching framework with time-varying transition probabilities. Now, that's a mouthful, I know, but it's really the engine of their discovery.
This is truly where the innovation lies. Think of it this way. Traditional models assume the market always plays by the same set of rules, or maybe operates in just one gear. But this nonlinear Markov switching framework essentially allows the market to switch between two distinct, unobserved economic states or gears. And in each of these states, the rules can change. Things like expected returns, how sensitive stocks are to economic conditions, even their volatility can be entirely different. It's like the economy isn't just cruising on one highway, it's got different driving conditions it can switch into, and those conditions dictate how everything else behaves. The model lets the market tell us which gear it's in, so to speak.
Well, so they're letting the data tell them what these gears or driving conditions look like, rather than imposing a single, unchanging structure.
Interesting. And through their rigorous analysis, they identify two primary states, largely defined by the level of market choppiness, or what academics call conditional volatilities. Can you tell us about these states and what distinguishes them? Certainly. They clearly identified two primary states. State 1 is the high volatility state. This state is characterized by significantly higher overall stock return volatility. We're talking about twice as large as what you'd see in the low volatility state. It's when the market is feeling a lot more jumpy, uncertain, unpredictable. Think of it as driving on a bumpy, winding road in a storm.
Okay, choppy waters.
Exactly. And then state 2 is the low volatility state. This is the calmer period with lower, more stable stock return volatilities. This is your smooth, clear highway drive.
Now, this sounds a lot like recessions and expansions, but I know there's a crucial nuance for our listeners here. It's not a perfect one-to-one match, is it? We're not just talking about the business cycle, strictly speaking.
That's an important caveat for you, the listener. While these high volatility states often do coincide with official NBER-defined recessions, they were moderately high during all 8 post-war recessions in their sample. They are not always identical to recessions. For example, the high volatility state also captured events like October 1987. That was a market crash, right? But not an official recession. It also picked up periods of high volatilities for growth stocks in the late 1990s dot-com boom. So we're talking about market volatility regimes, periods of higher-low market turbulence, not strictly business cycle phases, though there's certainly significant overlap. The key is volatility.
That distinction is key. Got it. It means they're not just relabeling recessions. They're identifying something deeper about how the market itself behaves. And it gets even more sophisticated because this model doesn't just switch states randomly, does it? It uses publicly known economic indicators, what they call conditioning variables, to influence the probability of switching between these states. This reflects the very real idea that investors are constantly processing information about future economic activity. What were the key variables they looked at to help predict these state changes?
Right. It's not random. They leverage several well-established economic indicators, essentially drawing from the same playbook that many professional investors use to gauge the economic landscape. First, the 1-month Treasury bill rate, TB. This acts as a kind of proxy for unobserved investor expectations about future economic activity. Historically, central banks like the Fed tend to raise short-term rates during expansions, to cool things down, and lower them during recessions to stimulate growth. So movements in the TB rate can signal shifts in economic sentiment or policy, giving us a clue about which gear the economy might be heading into.
Okay, so interest rates are a big signal. What else?
Then there's the default spread, DEF. This is the difference in yield between lower-rated bear and higher-rated corporate bonds. A wider spread often signals increased credit risk, and general economic uncertainty companies are perceived as more likely to default. It's a strong business cycle forecaster. And critically, value firms, often being more established or mature, they can be more exposed to bankruptcy risks during downturns. So this variable is particularly relevant to their study.
Makes sense. Riskier bonds paying more signals trouble.
Exactly. Third, growth in money stock. Measured as the 12-month log difference in the monetary base, this variable helps capture changes in liquidity and monetary policy shocks that can influence overall economic conditions. It's a way to track the availability of money in the system. And finally, the dividend yield, DIV. This is the dividends paid by the overall market relative to its price. It's a popular indicator. A high dividend yield can sometimes signal that investors are demanding a higher return for holding stocks, perhaps due to higher perceived risk or lower expected future growth. It indicates a shift in overall market sentiment.
So by incorporating these variables, the model becomes incredibly dynamic. It's almost like a sophisticated dashboard for the economy constantly updating and giving us the likelihood of shifting between, let's say, sunny and stormy market conditions. It feels far more realistic than just assuming one constant state.
Precisely. This framework offers a more realistic, dynamic picture of the market. It acknowledges that the underlying rules of the game can, and absolutely do, change. Understanding these states is crucial because, as you'll see, the performance and risk of value and growth stocks behave very differently depending on which state the economy is in. It moves us beyond simplistic, always true assumptions and into a world where context is king for understanding investment returns.
Okay, so with this powerful new lens of a two-state Markov switching framework, what did the researchers actually discover about how value and growth stocks behave in these different economic gears? Because this is where it gets really interesting, I think. The research reveals a stark almost dramatic difference in how these two categories of stocks respond to overall economic conditions, especially when market volatility is running high.
Indeed. The core insight is about what we call asymmetrical responses. Value firms are far more sensitive to worsening economic conditions than growth firms, particularly when market volatility is high. It's not just a subtle difference, it's a pronounced, statistically robust finding that truly differentiates their behavior.
That sounds incredibly important. Let's dig into some of the signals they looked at. Starting with the Treasury bill rate, or TB, how did shifts in short-term interest rates affect these different types of stocks, especially in that turbulent state one?
Right. Let's look at the high volatility state, state 1. They found that when the Treasury bill rate rose, expected stock returns generally fell across the board. That's sort of expected. But here's the kicker. This negative impact was significantly amplified for value stocks compared to growth stocks. To put that in simpler terms, during periods of high market stress, value firms were found to be approximately twice as sensitive to interest rate shocks as growth firms. So when rates went up, value stocks would see their expected returns drop at like double the rate of growth stocks. This suggests that in times of high market stress, value firms are significantly more affected by interest rate shocks, experiencing larger drops in expected returns as rates rise, or conversely, larger increases as rates fall.
Wow, twice as sensitive. So if rates are going up in a turbulent market, value stocks are expected to get hit harder, or at least feel the pinch more acutely. But what about in the calmer, low volatility state? Does that differential sensitivity still hold?
Well, in contrast, in the low volatility state, state 2, the expected returns of neither value nor growth portfolios were significantly affected by short-term interest rates. The impact was much smaller and largely insignificant across all types of stocks, actually. This tells us that in calm periods, short-term rate fluctuations don't exert nearly the same powerful influence on expected returns for either group. That heightened sensitivity of value stocks really is a feature of the high volatility state.
Fascinating. So it's not just about the direction of rates, but the context of market volatility that matters. That's key. Now let's look at another critical indicator, the default spread, DEF, which measures the perceived credit risk in the economy. What patterns emerge there?
A very similar, striking pattern emerged with the default spread. In the high volatility state, state 1, all stock portfolios showed a positive and significant relationship with the default spread. This means that when credit risk in the broader economy increased, when the spread between safe and risky bonds widened, expected stock returns also rose. Investors demand more compensation for that increased risk. But once again, this effect strengthened dramatically as you moved from growth to value stocks. Value stocks were significantly more sensitive to these shifts in credit risk.
So if the market starts signaling that corporate default risk is rising, value stocks react with a much stronger expectation of higher future returns than growth stocks. It's almost like they're shouting, "We're riskier here, pay us more."
Exactly. That's a good way to put it. This suggests that during periods of high market uncertainty and rising default risk, value stocks' expected returns are more positively correlated with the default spread than growth stocks. Essentially, they are more sensitive to perceived credit risk in the broader economy. When things look bad for corporate bonds, they look worse for value stocks, relatively speaking, and investors demand higher compensation for taking on that extra risk.
And was this sensitivity also muted in the low volatility state, just like with the Treasury bill rate?
Precisely. In the low volatility state, that's state 2, none of the coefficients on the default spread were statistically significant across any of the stock portfolios. This really reinforces the idea that the heightened sensitivity of value stocks to these aggregate economic conditions, to both interest rate shocks and credit risk, is a phenomenon predominantly of the high volatility state. In calmer times, these factors don't drive such a wedge between value and growth.
So if interest rates and default spreads are these strong signals of this asymmetrical response, what about the other conditioning variables they studied, like the money supply and dividend yield? Do they show the same clear, state-dependent patterns?
Well, the growth in money supply coefficients were generally not significant in this particular specification. It suggests it wasn't a consistent or powerful driver of these differential responses across states. The dividend yield showed a bit of a mixed bag in the simpler univariate analysis. While it had some significant coefficients in specific states for specific portfolios, these patterns became less clear or even insignificant in the more robust, comprehensive bivariate model. especially when they enforced a single latent state across all portfolios. This tells you that not all conditioning variables behave with the same consistency or strength in signaling these state-dependent sensitivities. The Treasury bill rate and default spread were the clear workhorses here, distinguishing value and growth behavior across states.
So while some variables clearly delineate the differential responses, others are less consistent. Okay. But the overall picture of value stocks being dramatically more sensitive in high volatility states, demanding higher expected returns for that risk, seems to be incredibly robust. Do they have statistical ways to confirm this wasn't just a fluke in their data? Or just, a random pattern?
Absolutely. The researchers performed rigorous likelihood ratio tests. These are advanced statistical tests designed to compare different models, essentially. They use them to formally confirm these differential responses, and these tests strongly rejected the idea, the null hypothesis, that the coefficients on the Treasury bill rate and the default spread were equal across the two states for both value and growth portfolios. This means it's not just a casual observation from the data, it's a statistically robust finding. Value firms are indeed more exposed to aggregate economic conditions when the market is volatile, and they respond to these macro signals in a fundamentally different way than growth stocks. For you as a learner, this is important because it means the evidence for these state-dependent dynamics is strong and reliable and not easily dismissed.
So we've established that value firms are much more sensitive to economic conditions when market volatility is high. Okay. Now, let's talk about the star of the show itself, the value premium. Does it hold steady, or does it truly dance to the tune of these economic states? Because for years, investors debated if it was even consistently there, right?
Right. And the study definitively shows that the expected value premium exhibits clear time variations. It is absolutely not a steady, reliable return stream. Instead, it behaves dynamically, almost like a market barometer, you could say. The pattern they observed is that the expected value premium tends to spike upward rapidly in the high volatility state, only to decline more gradually in the ensuing periods of low volatility. Imagine a heartbeat monitor for market returns. It surges during periods of market stress and then slowly calms down as conditions improve. It's a very clear cyclical pattern tied to these market states.
That's a powerful visual, a heartbeat monitor. So it's not a constant, but what does it average out to over the long term? And how often is it actually positive? Because if it's only there sometimes, does it really matter in the grand scheme?
That's a fair question. Over their extensive sample period, from January 1954 to December 2007, the expected value premium averaged a robust 0.39% per month. This translates to a significant average annual return, and importantly, it was a highly statistically significant finding, confirming it wasn't just random chance. Furthermore, it was positive for 472 out of 648 months, or approximately 73% of the time. So while it's not constant, it's generally there, offering that premium most of the time. That validates its existence as a long-term phenomenon, even if it varies quite a bit.
Okay, so it's there, it's positive often, but it's incredibly dynamic. This next part is truly one of the most striking findings, in my opinion. This is where the rubber really meets the road for investors. How do expected returns for value and growth stocks diverge based on the state of volatility? This feels like the core aha moment of the research.
This is indeed critical. The divergence is dramatic, especially when looking at 1 year ahead expected returns. It reveals a surprising shift in market leadership depending on the economic environment, conditional upon the high volatility state. Here's the truly surprising part. Expected returns for the value decile are substantially higher at 11.21% per annum. Now contrast that with growth stocks. Expected returns for the growth decile are actually negative, at negative 1.17% per annum.
Wait, that's a truly astonishing finding. Let me make sure I heard that right. During turbulent, high volatility periods, value stocks offering double-digit returns while growth stocks actually lose money. That completely flips the script for how many of us think about safety in a downturn. It says value, in some sense, provides a lifeline when the market feels most dangerous. What do you see as the biggest implication of that chasm?
That chasm implies a profound reevaluation of how we perceive risk and reward in different market environments. It suggests that the market is offering substantial compensation for holding these more cyclically sensitive value assets precisely when economic conditions are at their worst. This isn't just a statistical oddity, it's the market rewarding investors who are willing to bear the heightened specific risks that value stocks present during turbulent times. It means that what might feel like a period to hide could actually be a period where certain segments of the market offer significant upside if you understand their conditional behavior.
And what happens in the calmer, low volatility state? Does that dramatic premium still hold? Or does the market revert to a more balanced playing field?
No, the picture changes significantly in calmer times. Conditional upon the low volatility state, expected returns for the value portfolio are comparable to growth at 10.90% versus 10.26% per annum. In these calmer periods, that dramatic performance difference largely evaporates. This reinforces the idea that the true dynamic behavior of the value premium, its spike, is intrinsically linked to the underlying volatility regime. It's not a constant feature across all market conditions. When the storm passes, the differential advantage largely fades.
That is a profound insight. It's not just about average performance over decades, but about when that performance truly appears. Now, this also raises an important question about risk. We often hear about value stocks being less risky on average or at least cheaper, but this seems to imply a more complex relationship with risk, doesn't it?
You're absolutely right. The research also sheds light on the nuanced nature of value risk, distinguishing between an unconditional and a conditional view. Unconditionally. If you just look at long-term averages, value does appear less risky than growth, in a sense. Value outperformed growth in both low volatility states, with average returns of 18.92% for value versus 15.99% for growth, and high volatility states, 12.71% for value versus 2.60% for growth, on average over the entire sample. This aligns with earlier work suggesting value is unconditionally less risky in a broad overall sense.
Okay, so on average, it looks safer.
Conditionally. However, and this is crucial, the observed time-varying expected returns suggest that value is conditionally riskier than growth. This means that while value might deliver higher average returns overall, it does so by being more sensitive to the worst economic outcomes, particularly in those high volatility states. Investors are, in essence, being compensated for bearing this heightened conditional risk. The risk you take when things are truly bad is what generates the premium. It's the classic notion of no free lunch. The premium is a reward for taking on specific, concentrated risk.
So it's not that value is inherently less risky, but rather that its risk is concentrated in specific volatile periods, and is compensated handsomely for taking on that risk. Were these time variations in expected returns driven purely by changes in volatility, or was there something else at play?
They found it was driven by changes in both conditional volatilities, the level of market choppiness, and what we call conditional Sharpe ratios. A Sharpe ratio is a widely used measure of risk-adjusted return. It essentially tells you how much return you're getting for each unit of risk you're taking. Both value and growth portfolios showed conditional volatility spiking during most recessions and other high volatility events. That makes sense. Critically, conditional Sharpe ratios for both value and growth also displayed strong time variations. They increased rapidly during recessions and then declined more gradually in expansions.
So you're saying that the market is essentially offering better risk-adjusted returns during downturns,
Yeah.
a higher reward for each unit of risk taken, almost as if the market is putting things on sale, relatively
Yeah.
speaking, for those brave enough to step in.
Precisely. And the value advantage is noteworthy here. The value decile consistently exhibited predominantly higher conditional Sharpe ratios than the growth decile. It averaged 0.66 per annum for value versus 0.38 for growth over the entire sample. What this really means is that for the risk taken, value stocks generally offered a much better return efficiency than growth stocks across the entire period, particularly during certain moments. This further reinforces that conditional risk explanation and suggests that value, when it's hot, is offering exceptional bang for your buck, even after accounting for the increased risk.
Okay, this idea of the value premium spiking in high volatility states and behaving so dynamically is a huge departure from what many traditional models suggested. This begs the crucial question. Why did so many earlier models miss this vital behavior? What was their fatal flaw?
It really comes down to the fundamental assumptions embedded in those traditional models, doesn't it? For years, researchers attempted to predict the value premium using what we call linear predictive regressions. These models inherently assume a straightforward, constant relationship between predictors and returns. Think of it like trying to predict a complex mountain range with only a flat, two-dimensional map. You'll get some general idea, but you'll completely miss the peaks, valleys, and sudden drops.
Right. But the market isn't always linear, is it? It's full of twists and turns, sudden drops, and sharp inclines. It's far more like that mountain range than a flat plane.
Absolutely not. And this paper provides compelling evidence that those traditional approaches fundamentally missed crucial aspects of the value premium's behavior. Why? Because they lacked the ability to capture these sudden, sharp jumps or switches between different market regimes. They were trying to draw a straight line through a roller coaster, basically.
So the researchers put those traditional linear models to the test, comparing them directly against their own more sophisticated Markov switching framework. What did they find in their first specification test where they used a linear regression without any special adjustments, just a plain vanilla linear model?
Right. They ran a simple linear regression of the realized value premium on the same set of lagged economic indicators TB, DEF, and DIV that were used in their Markov switching model. The results were quite telling. This linear model fails to capture the time variations of the expected value premium in any meaningful way. It just doesn't see it. It completely misses the upward spike in the expected value premium observed in the early 2000s. That was a period marked by the tech stock bubble burst and a subsequent recession, a crucial time for value, as you mentioned.
And that was a very significant period for value investing, if I recall correctly. A moment where value stocks really shone after years in the wilderness.
It was indeed a pivotal period. And not just that, even during other high volatility periods like the recessions of 1974, 1975, and 1981, 1982, the linear models captured time variations were substantially weaker than those revealed by the Markov switching model. Essentially, it dramatically underestimated the actual volatility of the value premium. And it was far less able to connect its predictions with real periods of market stress. It was like trying to forecast a hurricane with a gentle breeze model.
So it's not just that it was off, it completely missed some of the most dramatic shifts, the very moments when the value premium was most pronounced. What about trying to make the linear model a bit more sophisticated? Did adding interaction terms, trying to account for more complex relationships, help it catch those dynamics?
Good question. Thinking that adding complexity might help, the researchers included what we call interaction terms with the 1-month Treasury bill rate in the linear regression. They chose the TV rate because it was a key instrument for state transitions in their Markov model, showing how important interest rates were in signaling shifts. But alas, even adding these interaction terms does not improve its ability to capture time variations in a meaningful way. It still misses the upward spike in the early 2000s. It still fails to fully explain variations in the 1974, 1975, and 1981-1982 recessions. While it slightly increased the premium's estimated volatility, it still dramatically underestimated the true dynamism and was even less able to correlate its predictions with the actual periods of high market volatility.
So it just got more complex without actually getting more accurate in those crucial moments. That's a pretty damning indictment of traditional linear models, wouldn't you say? It sounds like they just couldn't see the forest for the trees.
It's absolutely an aha moment on methodology. Yeah. This strongly suggests that the fundamental nonlinearity embedded in the Markov switching framework is essential for truly understanding these market dynamics. Linear models, by their very nature, rule out such switches or jumps between different economic states. They smooth over the sharp, sudden shifts in market behavior that the nonlinear model captures so effectively. For you as a learner, this is a crucial lesson in understanding the limitations of simpler models and appreciating how sophisticated econometric tools can reveal hidden truths about market dynamics. The market isn't just moving in a straight line, it's constantly shifting gears, and you need a model that can recognize and adapt to those shifts. It's about fitting the model to the reality of the market, rather than forcing the market's reality into a convenient but ultimately incomplete model.
We've established the what, that the value premium isn't constant, and it spikes dramatically in high volatility states while growth stocks falter. We've also seen the how, that a nonlinear Markov switching model is crucial to capturing this dynamic. But now let's get to the even deeper, more satisfying question. Why? Why does value behave this way? What's the economic intuition behind value firms being so much more sensitive to aggregate conditions during those tough market periods? It can't just be a statistical correlation, can it?
You're right, it's not just statistics. This is where the research connects its statistical findings to powerful investment-based asset pricing theories. These theories move beyond just observing patterns. They suggest that firms' actual investment decisions, their operational characteristics, and their financial structures fundamentally explain why their expected returns behave the way they do. It's about the economic engine under the hood of these companies.
Okay, so it's not just market sentiment or some anomaly, but something structural in the businesses themselves that makes them inherently react differently. What's the first theory they connect to?
The first is about operating leverage. This is a concept deeply explored by researchers like Carlson, Fisher, and Giammarino back in 2004. The idea here is that value firms, often older, more established companies with physical assets like factories or large equipment, tend to have higher operating leverage than growth firms. What this means in practice is that a larger proportion of their costs are fixed. Think about a traditional manufacturing company. They have substantial rent, machinery maintenance, and permanent staff salaries that don't change much whether they produce a lot of goods or a little.
Right. Those costs are sticky. And how does that characteristic play out when the economy takes a hit or when we enter one of those high volatility states?
Exactly. When economic conditions worsen, like in a recession or a high volatility, state revenues for all companies tend to fall. That's natural. But for firms with high operating leverage, because they can't easily cut those fixed costs, their profits, and consequently their equity values fall disproportionately more. The drop in revenue directly eats into their bottom line much more severely than for a firm with lower fixed costs or more variable expenses. This mechanism implies that value firms are more affected by negative aggregate shocks than growth firms because their profit margins shrink more rapidly. Therefore, their risk and expected returns increase more in recessions because investors are being compensated for taking on that higher operating leverage risk during downturns. It's a fundamental sensitivity built into their cost structure.
That makes perfect sense. Higher fixed costs truly mean more pain when sales drop. It's like having a big mortgage payment when your income suddenly disappears. What's the second theory that explains this dynamic?
The second theory is costly reversibility, a concept prominently featured in Zhang's 2005 work. The core idea is that many investments are costly reversible. It's generally easier and cheaper for firms to expand, to invest in new capacity, new product lines, or new markets than it is to contract. Contracting means disinvesting, like selling off specialized equipment, tearing down existing factories, or drastically scaling back operations. Imagine a tech company. It's relatively easy to hire more software engineers to build new features. Now imagine a steel mill. It's incredibly expensive and difficult to tear down a blast furnace or sell off specialized industrial equipment.
Ah, okay. So value firms, often with older, perhaps less flexible assets, are at a distinct disadvantage here in tough times because they can't easily pivot or shrink.
Precisely. Value firms, which frequently have older, less flexible, and often less profitable assets, often want to disinvest more in recessions to adapt to reduced demand or a shrinking market. But because disinvesting is so costly and difficult, their fundamentals are more adversely affected by worsening economic conditions compared to growth firms. Growth firms, by contrast, might have more flexible, newer assets, or their value might be tied more to future growth options rather than existing physical plant, making them more adaptable. This inflexibility makes value firms inherently riskier in downturns, thus requiring higher expected returns to compensate investors for that structural disadvantage of being stuck with costly to reverse assets.
That's a really powerful point about the physical constraints of a business. It's not just an accounting issue, but a real-world operational challenge.
Okay.
Okay. And the third theory?
The third is about financial constraints, from Livdan, Saprisa, and Zhang in 2009. This theory posits that more leveraged firms, companies with more debt, which often include value firms that rely on debt financing for their mature operations, carry greater debt burdens. In bad times, these firms face significantly higher interest payments and greater pressure to retire existing debt as their revenues shrink and their cash flows become strained. This can lead to what they call binding collateral constraints, where their assets are tied up as collateral for loans, limiting their ability to finance new, potentially profitable investments, or even to maintain existing operations at optimal levels.
So a double whammy. They're hit by falling revenues and a tightened credit market, making it harder to navigate the storm and even harder to access the capital they need to survive or adapt. It sounds like a vicious cycle.
Exactly. Such financially constrained firms are inherently riskier in downturns because their solvency can come into question, and their ability to invest in the future is severely hampered. Therefore, they should earn higher expected returns than less leveraged firms. In essence, you're getting paid for bearing the financial fragility of these companies when economic tides turn. These companies are more likely to struggle with solvency or face difficult trade-offs, so investors demand a higher return for taking on that extra concentrated financial risk.
So what does this all mean for us, the listeners? These theories aren't just academic concepts, are they? They sound like fundamental truths about business operations and finance.
Not at all academic in a vacuum. These theories offer a cohesive and intuitive narrative for why the value premium acts as it does. It's not just a statistical anomaly or a fleeting market quirk. It's deeply rooted in the operational and financial characteristics of value firms. That makes them inherently more sensitive to the ebb and flow of economic conditions, especially when volatility is high. Understanding these mechanisms helps us grasp the value premium isn't a free lunch. It's compensation for bearing a very specific kind of risk that manifests acutely during challenging market environments. It explains why value can be so painful during a downturn, but also why it holds the promise of significant outperformance when the market is at its most stressed.
We've covered a lot about how the value premium behaves and why. That's clear. But the ultimate practical question for many investors is, can we actually use this sophisticated Markov switching model to forecast returns and make money in real time? Can we time the market with it, jumping in and out for superior returns?
That's the million-dollar question for many, isn't it? And the research provides a really nuanced and important answer here. While the Markov switching model clearly explains in-sample variations in the value premium, meaning it's great at describing what happened in the past and why, the economic significance of out-of-sample predictability from this model is close to non-existent for general market timing. You can't just plug in the numbers and expect to consistently beat a simple buy and hold strategy across all conditions all the time. It's just not that simple.
That's a very important distinction, because many investors dream of that perfect timing model. Close to non-existent sounds pretty definitive for general market timing. Can you give us some of the details they found when they tried to implement a real-time trading strategy based on this?
Certainly. They conducted rigorous out-of-sample forecasts by re-estimating the model recursively each month, using only information available up to that point, simulating a real-world scenario. While the out-of-sample forecasts were indeed highly correlated with the in-sample predictions, suggesting the model captures consistent patterns, the practical results for a broad timing strategy were, well, underwhelming. When they applied a switching portfolio strategy, meaning go long in the equity if predicted positive, otherwise hold treasury bills, it only slightly outperformed for growth stocks over the long run. And for value stocks, it actually underperformed a simple buy and hold strategy over the full sample period from 1977 to 2007.
Huh. So in general, for the average investor, it wasn't providing a clear-cut advantage for simply going in and out of the entire market. It seems like constant market timing is incredibly difficult, maybe even impossible consistently. But I understand there's a really interesting twist here, and this is where the model's true power seems to lie when you look at specific economic states.
This is the interesting twist for you, the listener. While overall out-of-sample predictability for broad market timing is weak, the story changes dramatically when looking at specific economic states. Let's consider what they call bad states. These are either NBER-defined recessions or the model's identified high volatility states.
So during the most challenging market environments, the periods of greatest fear and uncertainty, is that where this model shines?
Absolutely. During these challenging periods, the switching portfolio substantially outperformed a simple buy and hold strategy. To give you some context, for growth stocks, a simple buy and hold portfolio actually had a negative mean return of negative 1.50% per annum during NBER recessions. Ouch. In stark contrast, the switching portfolio, which would have moved into treasury bills during these predicted bad times, yielded a robust 12.27%. That's a massive difference between losing money and gaining double digits.
Wow.
And for value stocks, buy and hold returned a modest 2.23% during recessions, but the switching portfolio delivered an impressive 15.26%.
That is a significant finding. It means that in the most challenging market environments, when fear is rampant and losses are common, being able to switch out of equities into treasury bills, as predicted by this model, provides immense protection and delivers vastly superior returns. It's almost like having a built-in safety valve that works when you need it most. This isn't about constant timing, it's about tactical defense, isn't it?
Exactly. This highlights its profound power as a risk management tool and a guide for tactical asset allocation during critical periods, rather than a precision timing instrument for all seasons. It's about knowing when to be defensively positioned. Conversely, during good states, NBER expansions, or the model's low volatility states, the switching portfolios underperform the buy and hold strategies. This implies that during calm, growing periods, staying fully invested in the equity market generally yields better results than trying to time the market using this model's signals. You don't want to get out of the way when the market is simply doing what it's supposed to do, generally speaking.
So what does this all mean for us as investors and learners? It sounds like it's not about being a constant market timer, which is tempting for many, but about understanding when the model's insights are most potent, particularly for capital preservation. Is this essentially saying that constantly trying to time the market is often a fool's errand, except perhaps in the most extreme conditions?
That's a very fair summary, I think. What this tells you is that while this advanced model provides profound insights into how the value premium behaves, translating that directly into consistently superior market-wide timing across all conditions is incredibly challenging and often counterproductive. However, its power truly shines in risk management during downturns and volatile periods. Understanding these bad states and the conditional behavior of stocks within them could be incredibly valuable. Not necessarily for pure alpha generation always, but for capital preservation and making tactical shifts when the economic winds blow coldest. It teaches us that effective strategies are often context dependent, and sometimes the best move is to know when not to be fully invested, or at least when to be in different assets. Hashtag tag tag outro.
What a deep dive. You've just journeyed through the dynamic, shape-shifting world of the value premium. We've seen how the market truly operates in these distinct high and low volatility states. And critically, how value stocks, far from being static, are exquisitely sensitive to aggregate economic conditions, especially when the market is turbulent. We learned that the value premium surges dramatically in these challenging times, actually offering significant positive returns while growth stocks falter, and that traditional linear models simply cannot capture these crucial jumps and regime shifts in market behavior. They just smooth it all out.
And we've linked these robust statistical findings to fundamental economic theories about operating leverage, costly reversibility, and financial constraints, offering a cohesive and intuitive why behind the market's seemingly erratic behavior. We've seen that while the sophisticated model doesn't guarantee outperformance through constant market timing, its insights are invaluable for navigating and preserving capital during those critical downturns, allowing for more informed tactical shifts when conditions demand it most.
So, what does this all mean for you, the astute investor and lifelong learner listening in? It means that truly understanding market dynamics isn't about finding simple, unchanging rules or seeking a mythical silver bullet. It's just not out there. It's about appreciating the constantly shifting landscape, embracing the sophisticated tools that can illuminate these changes, and knowing that market performance is deeply contextual. This deep dive empowers you with a more nuanced perspective on risk and return, especially when it comes to value and growth investing. It's not about whether value or growth is better overall, but understanding when and under what conditions each performs, and critically, why.
This raises an important question for all of us to consider, doesn't it? Given that the expected value premium spikes precisely when market conditions are most challenging and growth stocks are struggling, essentially, when everyone else is panicking, does this mean true value only truly reveals itself under immense pressure, offering a crucial lifeline for returns when they are most desperately needed? Or does it simply represent the market demanding higher compensation for higher perceived risk in those difficult moments, highlighting that risk and reward are intrinsically linked, especially when the going gets tough?
Something to ponder as you navigate the fascinating, ever-changing world of financial markets. Until next time, keep digging, keep learning, and keep diving deep.